This conference will now be recorded.
Well, welcome everybody to our Renville County HRA EDA Lunch and Learn. We like to do this on a monthly basis. Typically, we meet on the second Wednesday of the month over the noon hour. If there was a silver lining to the COVID situation, it got everybody used to doing this, doing meetings online, which we transitioned to doing them online. And knowing if we were, let's say, in Fairfax doing our Lunch and Learn, it's a bit of a haul coming from Sacred Heart. So we do this online just to save everybody some windshield time for everybody's convenience on this. But every month we have a different topic, somehow business related. So we like to bring in local subject matter experts to chat and try to share their knowledge and to get everybody informed and educated on the latest and greatest for economic development topics. So this month we are talking about something that is near and dear to everybody's pocketbook, taxes. And knowing that the calendar is going to flip here in just under 2 months, year-end taxes, what can we do now for businesses to try to save or defer or whatever we can do to help with our tax bill? So our speaker today is CPA and enrolled agent Sheila Prax. Many of you may know Sheila. She is from the big town of Fairfax. She began her career in accounting at Schaefer and Schaefer in Fairfax, where she received her training in bookkeeping and administration. She continued working in the accounting field as the bookkeeper and tax prep. When her family moved to the big state of California, I felt bad, Sheila, when you left, going to California. You're going to miss the snow so much, huh?
That's right. Or
Yeah,
not.
something like that. Well, the snow lured her back, or other reasons lured her back. And she returned to Minnesota in 2021, and she specializes in controller and accounting services for those having tax issues. She's involved in a lot of different civic groups. She's on the HRA, the EDA in Fairfax, and on the Renville County HRA EDA. So today she's talking with us a little bit about year-end things businesses should at least consider doing to try to help with their tax bill. So with that, I'll turn it over to you, Sheila. Thank you so much for presenting today.
Well, thank you. Thank you for inviting me, Jordan, and kind of going through my history. Yes, I originally grew up in the Fairfax Hector area, and my husband and I did leave for California for about 30 years, raised our kids. They in turn spread their wings and are living all across the country. So we returned back home, figuring we're kind of in the middle of everybody. And so I was taking my accounting and tax skills back here to rural Minnesota, and kind of focusing more on the accounting side of things, since we had some great tax preparers in our local community. So that's kind of the background that I have, and the focus that I have is, like I said, on the accounting and finance side of things. But we can go through to the next couple of slides there. We've got a bit of an agenda. We've done the introduction. There'll be an overview, kind of what's new in tax laws, and then a little bit of tax savings tips on both business and individuals, as well as a final summary. So if we want to take a look at the overview, that's great. And so we have kind of five sections. I tend to spend a lot of my time in the first one, which is financial records. Whether you are a business or just an individual who works and collects a paycheck, having financial records, understanding them, having them up to date and accurate, it's kind of the foundation of being able to do anything, any of the other items that are listed there. So I tend to work with a lot of people on their balance sheet and income statements of their businesses or corporations. But it does also come into play if you have a check stub, you want to make sure everything's accurate and up to date. With that firm foundation, then you can kind of move to planning. Of course, the standard is to defer revenue, push revenue out as far as you can so that you don't have to pay tax on it, accelerate your expenses, bring them into the current year if possible. All of that in an effort to lower your tax liability, which in turn increases your cash flow. There are times, depending on on Congress, if you expect the tax rates are going to go up, you might decide to pull revenue in, but for the most part, people defer revenue, hoping to, pay either at a lower tax rate or if they're lucky, not at all. Based on that, having that kind of planning, you can move to compliance. If your books are in good shape, you understand, you've done your tax planning, you can meet your due dates of whether it's your tax returns, your 1099s. I'm a firm believer in extensions for various reasons, but even to file an extension for your tax return, you do have to have a good understanding of how your year has been, what your income and expenses were. There are tax estimates that people are required to pay. I put the W-4 on there because that is a tax planning opportunity for wage earners. They can adjust their withholding depending on an annual, well, at least on an annual basis, more often if they actually identify a tax saving plan, they can make adjustments. And then the big one under compliance is for audits. If you don't have good financial records, it's really hard to get yourself through an audit without having additional taxes assessed. So having that firm foundation of good financials certainly helps in the compliance issue. That moves on to lending. If we have any bankers or lenders or even borrowers in the meeting today, they will always be looking for business plans. And so again, that goes back to your financial records. They will look for your financial statements. And then in lending, fair market values also come into play. And then lastly is the investment section. If you have all of your finances kind of, like I say, the firm foundation, you've done your tax planning, you might have an increased tax flow, you might have some extra cash. That's the opportunity to look into funding your retirements, estate planning, gifting, those sorts of things. So there is a lot that can be done if you have your financial records up to date, accurate, and you have an understanding of what your opportunities are as far as tax planning and compliance and things. So if we can switch to the next slide, we're going to go through the few items that are new. And if you have questions as we go through, please, just stop me. We can kind of go into a little bit of detail. Again, as kind of was displayed on one of the first ones, there is a little disclaimer that, I don't know your situation. I'm just kind of giving very generic tax planning ideas. It may or may not be right for you, but we can at least discuss them. So I think our first is what's new in business. So if you have your own local CPA tax preparer, this is the time of year when they start taking all their classes, probably over the next month or two. And one of the new things that we see for businesses is the annual 1099 filings. This is where you file a form if you pay rent, if you pay more than $600 for services, if you pay interest on a loan that is not to a bank, maybe a private lender. The e-filing requirement used to be if you filed more than 250 returns. Starting January 1st, it is going to be if you file 10 or more. So this is a really big change for businesses that have filed their own, maybe paper filed, maybe even handwritten 1099s and mailed them to the IRS. That's no longer acceptable. The IRS has created an online portal. It's called IRIS. And through that online portal, you can sign up for an account. It does take some time because they do want to verify you to make sure that all of the data, because you will be submitting social security numbers and names and addresses, everything has to be secure. So I have heard that it takes 30 to 45 days to get fully signed up and prepared. Now that might be for like CPA firms that file on behalf of others. If it is just you as an individual, it may take less time, but this is a brand new portal that they are getting up and online. You can submit your forms there, and it will keep the history. So you can go back and review who you've sent to before. There is also their old system, which was called FIRE. That would be to download some computer software and e-file through that system, but they are preferring the IRIS system. And I did put on there the IRS publication 5717 is the instructions basically for how to get registered and how to submit your forms this year. For the most part, they are all due by January 31st of 2024. The other item that you may not have heard of before, whoops, go back there, yeah, is this FinCEN. It is, it's a new term. It is again a 1/1/24 regulation, and this comes through the Financial Crimes Enforcement Network. What they are trying to do, and I'm sure that you've read some about it, that you know there are many businesses that are created, corporations, LLCs, and there may be many layers of ownership within those companies. And so the government is trying to gain an understanding of who owns or who controls these businesses. So starting on the 1st of next year, they have a new requirement that any new companies after the 1/1/24 will have 30 days to register. Again, it is through the FinCEN.gov website, but they have 30 days to register. If you are a corporation, if you are an LLC, or if you are some other type of entity that is created with a Secretary of State filing. And so for new companies, whether, you know, if you hear of somebody, this, like I said, this is kind of brand new, remind them that they do have a reporting requirement. If you have been in business for years, you have an extra year. So if you are in business before 12/31 of this year, you have until January 1st of 25 to make your initial reporting. That initial reporting is your legal name, any trade name, the street address of the business, the jurisdiction and country, and your tax ID number. So fairly simple information. You also note if it's an initial registration, a correction to a previously filed registration, or an update. The next section beyond reporting the company is to reporting what they call beneficial owners. And these are people that have substantial control over the company. It could be the CFO, it could be the CEO, the COO, or anyone with an ownership interest of 25% or more, direct or indirect. So in reporting these people, it is the name, the date of birth, their street address, and then a photo of a non-expired ID, which is a passport or driver's license. So this is going to be a lot more effort. You know, if you are a single member LLC, maybe not so much, or a single shareholder S Corp, not such a big deal. If you are a company with a board of directors that changes, you know, on occasion, or ownership that may change, you have to submit the information on these beneficial owners, and you have to keep it up to date. So if the driver's license expires, you have to, of course, update that information. If a passport expires, if someone moves to a new home, all of those things need to be updated. I did put in red, and granted, it does say willful failure to file, which is probably an important thing, but willful failure to file a complete initial or updated report with FinCEN is subject to $500 a day penalty, up to $10,000 in imprisonment for up to 2 years. So there's a little bit of bite into these new regulations. I did put the government website and the frequently asked questions so that, if someone is interested, they can go take a look at what is required. This is something that is the company's responsibility. Your CPA may assist you in filing, maybe your attorney may assist you in filing. The class that I took suggested maybe to leave it to attorneys because there is a liability with this. If I submit for someone and one of their CFO changes, right? They hire someone new and I didn't know about it, I am not going to be able to update that for them. So there is liability on the people who make these submissions. So check with your CPAs, check with your attorneys to see if they will assist you. I am guessing overall it's probably not that difficult to do on your own, that it will be a website where you just upload or fill out the information that they require. Based on those, we'll get to a couple of easier things. Bonus depreciation is something that's been around quite a long time. For the past probably 5 years, the bonus depreciation amount has been 100%. And when it first started, some years it was 50% or 30%, but it's been 100% for quite a long while because of the efforts of trying to get business owners to invest, right? To invest in new equipment and things like that. The current regulations call for this percentage to decrease over the next 5 years. So for 2023, it is 80% that you can write off as first year bonus depreciation. 2024, it will be 60% and then kind of go down each year. Historically, Congress has met in December and has bumped it back up to 100%. I am not sure that that is on their agenda for this year. They have other things they're trying to work through. So it would not surprise me if it remains at 80% for this tax filing season. Another thing that has reverted back, of course, during COVID, there were many regulations that were put out to try and keep, to keep businesses up and running. And one of them were the restaurants. And so during COVID, I believe it was from 2020 through 2022 tax years, if you purchase meals at restaurants for your business, they were 100% deductible. That has now reverted back to the original rules of 50%, and that is for this current year. So it was at 1/1/23. The standard mileage rate for business use of autos has gone up. It is 65.5 cents per business mile. That, of course, the standard rules, you have to be able to document it, your personal miles versus your business miles, but it has gone up this year about, I believe it's about 3 cents. So 65.5 cents per mile there. And then just a reminder that each year they adjust, if you are a self-employed person and they pay self-employment taxes, the Social Security portion of that is now at $160,200 is the max, and that is up from $147,000. The portion of self-employment earnings that is Medicare does not have a ceiling. It is only the Social Security portion, the 12.4%, that is maxed out at $120,000. So that is kind of what's new on the business side of things. I don't know if anyone has any questions or comments that have come up, but if so, please let me know. Okay, so we will go on to individuals, kind of what's new there. The big thing is the federal standard deduction. This changed in about 2018. They increased it dramatically. And so a lot of people are taking the standard deduction now versus keeping track of their medical expenses, their mortgage interest, their state taxes paid, their charitable deductions. If you are married, it's $27,700. This year, if you're single, it's $13,850. If you are over 65, you get an extra amount there. So married gets an extra 3,000, single gets an extra 1,850. So that made tax preparation a lot easier for a lot of people, having that high standard deduction. It just meant a lot less paperwork you didn't have to deal with. This is set to expire. It does go through 24, it does go through 25, and then it will revert back to those 2017 amounts, where single will only be 6,350 and married will be 12,700. So we've got a couple good years left, and then we may have to start keeping track of our expenses again. A new thing that Minnesota has is earned sick and safe time. So if you are a business owner or you're an employee, this is important for both of you to know. It starts on January 1st of 24, and it must be listed on the pay stub. I know if you use QuickBooks for payroll, it will calculate this for you. If you do manual payroll, you'll be doing some spreadsheets or some calculations. There are 3 ways that your employer can basically accrue this for you. They can either accrue 1 hour for every 30 hours worked, with a minimum of 48 hours a year. If they choose that method number 1 to accrue it based on every hour worked, you will get the minimum 48 hours a year, and you can carry over any unused amounts up to 80 hours. If the employer chooses, they have a second alternate, they can front load it. They can just say on January 1, you have 48 hours of sick leave. And then you utilize it at any point throughout the year. And at the end of the year, if you have any remaining balance, they will pay it out to you. It's a little less calculation. It does mean that you will be paying out as an employer 48 hours per year, used or unused, by the end of the year. So that is an option that they could choose. The third one is to front load it with no payout, which means you put the hours at the front of the year. On January 1st, they get a minimum of 80 hours of sick leave or safe time, but there is no payout. So if it is not used, it's lost. So those are kind of the 3 options that the employer can choose. And this will be something that I believe they will be updating their employment manuals to let the employees know which option they chose. I believe these options can be reviewed and changed each year. So, you know, if they choose one option and it just is too cumbersome, they could maybe the next year choose a different option. Option number 1, where they accrue it, if it is unused at the end of employment, it is not required to be paid out. So again, I did put the website where businesses and, you know, if employees want to kind of understand this benefit, they can take a look and get an understanding of what that is. But we should start seeing that on the paychecks for any payrolls after January 1st. Minnesota has a couple new minimum wages. I don't know how often they're used. From what I can see here, most people are paid above the minimum wage, but large employers, who are those who make $500,000 in revenue or more, are at $10.85. Smaller employers, training wages, youth wages, minimum wage is $8.85. There are a few child tax credits that are new this year, or they aren't new, they've increased. So for 2023, Minnesota is $17.50 per child. It does phase out at $29,500 to $35,000 for married filing joint. So it is a credit for the lower income parent. The federal also has a tax credit for children or for dependents, and it phases out at a much higher rate, $200,000 to $400,000. So for those of you with kids, that is a great benefit, at least on the federal level, and for some, well needed on the state level if they meet those income requirements. The IRAs have raised a little bit. Of course, they do try and promote saving for retirement as much as possible. So both IRAs and 401ks are tax deferred. You will get a deduction off your tax now, but at some future date when you withdraw at retirement age, you will have to pay tax on those. So for individuals, an IRA is $6,500 with $1,000 catch-up if you are age 50 or over. And 401ks, the max is $22,500 with a $7,500 catch-up if you are 50 and older. So if those are typically 401ks are offered through your employment, IRAs are more of a personal retirement plan. You can, if you are self-employed business, just a single business owner, you may or may not even have employees, you can do a solo 401k, and that allows you to put a lot more than the IRAs, so you can reduce your income that way. For those people who have their IRAs and their, well, not so much 401ks, their IRAs, their simples, there is an age when the government does require you to take a minimum distribution. And that age used to be 70. It did get revised during COVID. They decided they were not going to force people to take distributions at that time. So they increased it up to 72. And now as of 1/1/23, it has gone up to 73. So if you were 70 in 2020, you have to continue to take it. And if you were 72 in 22, you have to continue to take it. But if you turn 73 this year, you can wait an extra year. Wait till you turn 73. The last thing I think that is new for Minnesota is some of you may have received a direct tax rebate payment in the last, I'd say, month or two. I believe it was $260 for individuals and up to $560, $540 for married couples. There were also credits for if you have children in the house. Minnesota will not be taxing that amount. The federal government, they were not sure. My guess is that the federal government will not tax it. From what I've seen in other states, it's often a return of they consider it a return of a state tax, which is typically, they do not tax it at the federal level if the state is not taxing it. So I don't know if there's any questions on the individuals. If so, you can let me know. But that is kind of what's new for 2023. So we do have some tax saving ideas for businesses. If you are a business that has inventory, let's say you are a hardware store. Typically in the past, if you had inventory, you had, even if you were a cash basis taxpayer, your inventory had to be on what they call accrual basis. You could not deduct it until it was sold, right? So if you bought inventory, it would be on your balance sheet. You couldn't put it through your profit and loss until you sold it. That has changed. As long as you are a business, and a small business here is considered under 29 million a year, you can basically expense that inventory as non-incidental materials and supplies. You no longer have to maintain that on an accrual basis. So that's made a fairly big change for some small business owners. Another change that's come in the last few years, it's great to reduce your taxes, it is an election that you make each year. And the election is that if you have basically repairs and maintenance, they have a $2,500 de minimis safe harbor election. And that means that if you had repairs done on a piece of equipment, or even if it was one of the vehicles that you use in your business, if the invoice is under $2,500, you can just call that a repair. You don't have to capitalize it as an improvement. And so that helps a lot. Maybe you have a rental and you had to replace a few windows, which normally windows are part of the building and are very long-term depreciation. If the invoice is under $2,500, you can now expense those types of things. So that is something that people kind of keep in mind, that they expense when possible, and it is per invoice. They also have what's called an accountable plan. This is especially helpful for S-Corp shareholders. Because S-Corp shareholders are employees of their S-Corp, they can create a very simple document that's called an accountable plan, and the corporation can reimburse their employee, which is the shareholder, for things like office and home expenses or auto expenses. If they're using their personal auto on behalf of the corporation, they can get reimbursed. This is a deduction for the corporation, but it is not claimed as income to the shareholder. But it is important to have that accountable plan. Otherwise, it would be taxable to the shareholder. So you do want that, where the corporation gets a deduction, but the employee does not have to claim, because it's a reimbursement. It's not income. In order to use the business use of your home, the rule has always been there. You have to use it regularly. You have to use it exclusively. It could be just a table in the corner of a room. It does not have to be a whole room, but it does need to have no personal use. Your kids can't, play video games there or do homework there. It needs to be a place where you do your administrative work or meet with clients. Some people do have a separate structure, and that is very helpful to use as a business use of home. We talked about the bonus depreciation no longer being 100%. This is for new assets that you might purchase. Could be a new piece of equipment, that type of thing. You do have a choice, and oftentimes I'm sure it's your tax preparer that makes this choice on your behalf, but it's always good to know that the options are available to you. You have bonus depreciation at 100% or 80% this year. You do have Section 179, which is also a first-year write-off of equipment type of things. The bonus you can elect out by class. Let's say you get 4 pieces of equipment. If you decide you don't want to use bonus depreciation, then none of those 4 get to use bonus. If you elect out of Section 179, you can do that on each piece of equipment. You can pick and choose what you would like to do. So, in years where both options were 100%, for the most part, it doesn't really matter. It reduces your income, it reduces your taxes, both at 100% of the piece of equipment. Where it does come into play, if you are a self-employed person, so you have a Schedule F for farm, or you have a Schedule C for a business, so that in both those cases you do pay self-employment tax. The choice between bonus and Section 179 can make a fairly large difference, and I'll have an example of that later. But bonus depreciation can create a loss for your business. It can make it, maybe your farm schedule or your business schedule can have a loss for the year. Section 179 cannot do that. It can only bring you to zero, but it can't make it negative. And you would automatically think that bonus would be the way to go. You deduct as much as you can, you get your income as low as you can, it saves you taxes. The loss that you create with bonus carryovers can basically create a net operating loss that will save you federal tax in the future. Section 179, if you're not able to use it all, can carry over as well. So we can talk about those two options. The last item for an extra deduction for you for business owners is what they call QBI or 199A deductions. And this came out several years ago when the tax laws changed for corporations, that C corporations tax rates went from, I believe it was 35% down to 21%. So they got a huge reduction in their tax rate. And so what happened is, of course, everyone who's not a C corporation wanted a similar benefit. And what came out of that is this QBI or 199A deduction. And what you do is after you calculate your business net income, you will calculate up to 20% of that and write it off as well. So that in turn kind of makes up for what small businesses or non-C corporations, it kind of gave them a similar tax benefit. And so that is another way that you can reduce your taxes as well. There are a few credits that might apply to you. There is a tax credit in the tax world, credits are more valuable than deductions. When we talk above there about expenses, those are all, amounts that you can use to reduce your income. But when it comes to credits, those are more of a tax savings. And so one of them is for small employers who want to start a pension plan, right? They've got employees that they want to reward for staying with them, and maybe offering some sort of a retirement plan is something they want to do. And so if you are a small employer, there is a credit to help you get that set up and administer the plan and to educate the employees about the plan. And they will do that for up to 3 years. And so what that will do is if it costs you $2,000 to set up a plan and to have meetings to educate something, 50% of that cost, so $1,000, can come right off of your tax bill. And so it's not $1,000 expense, it's $1,000 off of the tax amount. So that is kind of a something, an encouragement for small employers. Everything is kind of working toward getting people to save for the future. And this is one method of getting small employers to kind of consider having some sort of a retirement plan available for their employees. The other thing that I have seen in the last few years is if people update, let's say, the opening, their doors or their sidewalks up to their businesses, there are disabled access credits. And so if it is 50% up to $5,000 credit. So if you spend $10,000 putting in a ramp or a new door or something like that, you can get a credit up to $5,000. And of course, that's, again, that is a tax credit. And so that offsets your tax bill at that point. So those are a couple of good credits that we're starting to see more of. And so again, if you've got a question, let me know, but those are a couple of the new things that affect businesses. This is if you are a small business owner, and we talked about the difference between bonus, and I'm taking it at 2022's rates, which was 100%, versus the Section 179. So just as an example, on the top part of this calculation, in the green, we can see that for year 2022, the business had a $100,000 profit. And they decided to buy several pieces of equipment, and the equipment, and it may even be that they are making payments on it. It's not that they had to pay $200,000 in cash. They just purchased equipment, maybe financed it, but the equipment was worth $200,000. They can write that off as first year expenses. Now, if they do it as a bonus, of course, that gets them to a net loss of $100,000 for the year. And so there's no tax. I mean, this is a very simplified, but there would be no tax if you had a loss of $100,000. And that loss can be carried forward as part of a net operating loss. So the next year they made $160,000, but they didn't purchase any new equipment, but they had this NOL, this carry forward of their loss from the prior year, and that got applied, and so their adjusted gross income $60,000. Now you can see in column 2, next to the $160,000 of net income in 2023, I'm sorry, there is the 0.153. There's the self-employment tax, and so that tax is $24,480. Then their regular federal tax, after a standard deduction, they get down to taxable income of $32,000. It's at a 12% interest rate, so their federal tax is $3,800, and total tax bill for the year is $28,356. Now, if your eyes are glossing over, I totally understand. This is kind of the realm I live in, and hopefully I can just kind of give you an overview of what options and choices, and you know, asking questions of your tax preparers. So in 2023, this person who made $160,000 has $28,000 of tax. Now let's compare if they had taken Section 179 instead of bonus. So on the bottom half, they get the same. They get to take the whole thing. But as I had said before, Section 179 cannot create a loss. So they basically have to carry over $100,000 to the following year. It gets carried over on their depreciation schedule, and it sits there until they need to use it. And so there is no tax in 2022 because they took their income down to zero. In 2023, they make the same $160,000. They decide to utilize that carryover of the Section 179, and so they end up with $60,000 net profit on their business. Times the self-employment tax, that is $9,180. They take their standard deduction, they have the same taxable income, the same federal tax of $38.76, but you can see the difference from up above. They're only going to be paying $13,000 in taxes instead of $28,000. So the numbers are all the same. It is just the benefit you can get from one choice over the other, and the benefit of knowing that in the future I'm going to have a really good year next year. So do I want to use bonus? Do I want to use Section 179? So although it might be confusing to look at this and understand all of the details, the thought is just be aware that there's a difference, and you can certainly ask your preparer to, well, one, if you give them the information that next year is going to be good or next year is not, it will help them in deciding or assessing the best route for you. Okay, can we go to the next one? Okay, so this is for individuals. So this is more on your personal return. You've done all your business side of things, or you are a wage earner. And so we had talked about the fact that standard deductions are very high right now. So you do not necessarily have to keep track of all your medical expenses or all of your state taxes paid, things like that. So the tax tips that come for individuals is more of a way around getting the standard deduction plus getting some other deductions. So on the medical side of things, on a standard deduction, your medical expenses have to exceed 7.5% of your adjusted gross income, which for most people, you've got to have pretty high medical expenses for them to give you any sort of a deduction. So one of the options is to consider if your employer offers an FSA plan, which is a plan where you can designate a certain amount of pre-tax money to cover medical expenses. You can do that each year, and so that is an opportunity to take money that you would have spent on medical expenses anyway. You know, you got your paycheck, you have to pay the doctor's bill. Well, if your employer offers an FSA plan and you tell them to withhold, you know, a couple $100 a month and kind of set it aside for me, and when I get a medical bill, I will submit it to you for reimbursement, right? So you still have to pay your medical bill, but the money that you set aside every month is not being taxed. So it's reducing your salary by that couple $100 a month or whatever you decide. So the net effect is that the money you spend on medical is not being taxed. Same thing if you have a high deductible plan. If you get a plan either through a private insurance or through what they call Obamacare, and you have a high deductible plan, you can put away money into what they kind of call it a medical IRA. So each year you can choose to put, if it's just you, $3,850 if you have an individual health insurance plan. If it's a family plan, it's $7,750 plus catch up again if you are older. And so you can basically put money into what I'm just going to call a medical IRA. It's a deduction on your tax return, just like a regular IRA. And it can sit there. If you don't have any medical expenses this year, that's great. You can add to it again next year, add to it the following year. When you have medical expenses, you take them out and you pay it, but you do not have to pay tax on that money when you take it out. So as long as it's used for medical, it is a tax-free benefit there. So take a look at your insurance plans and see how, you know, if you qualify to have a high deductible, that might be something that is a tax savings for you to put that money aside for future medical expenses. If you are self-employed, of course, there is a self-employed health insurance deduction on your tax return. So if you cover your family, because if you're self-employed, you can cover your family and your children as well. And that is a deduction for you off of the second page of your tax return. If you are a business owner who has an S Corp or an LLC or a partnership, I'm going to kind of go between individuals and these business owners. These entities that you are in, partnership, LLC, S Corp, don't have to pay tax. All their money flows into you, and you put it on your 1040 and you pay tax at that point. One of the things with having the bigger standard deduction is you don't get a deduction for state taxes paid, or it's limited to $10,000. So if you have state tax, you might have properties that you own that you pay real estate taxes on. There's a $10,000 limit. So there are people that exceed that limit and they lose any benefit on taxes above that. If you have one of these entities, the state of Minnesota now allows those entities to pay some tax on your behalf. And so it's kind of a workaround. You know, if you're limited to the standard deduction, it's kind of a workaround for your entity to pay some state taxes. It flows through to you and you get the credit, and the entity gets a deduction. So that is called your pass-through entity, or PTE credits. So something to consider if you are the owner of an S Corp or an LLC. Again, part of the standard deduction that gets very limited for people is charitable contributions. If you're taking a standard deduction, you know, but you're giving, let's say, $5,000 to charity over the course of the year, you don't really get a deduction for that because the standard deduction is so high. So there are a few. You can get a very small deduction on the front of your tax return, either $300 if you're single, $600 if you're married. So they do give you a little bit of a benefit, a little bit of encouragement to you know, help those nonprofits or churches or things like that. The government does try to encourage people, you know, to give to charity. It is something they've done for years. So they do have that small amount, even if you use your standard deduction. Another way around that, if you or someone you know is taking their required minimum distributions, they've hit age 70, 71, 72, 73. They are starting to take these required minimum distributions, but they like to give to charity. There is a benefit that they can do. Instead of taking their required minimum distribution, putting it in their checkbook and writing a check to the church, which they don't get more than $300 or $600, you know, deduction for, they can tell the administrator of their retirement, you know, whether that's, let's say, Edward Jones or the bank or someone like that, they can say, well, instead of giving me the full thing, since I always give, let's say, $5,000 to the church over the course of the year, send that directly to the church and give me what's left. And what happens with that is the church gets its money. We don't worry about the charitable donation, and they are not taxed on that $5,000 because their RMD is reduced. And so if they normally took out, say, $35,000 and they were taxed on $35,000 and gave 5 of that to the church with no benefit, they now are only taxed on $30,000. So they got a full benefit of the charitable amount that they gave to the church directly from their IRA. So that is a benefit for older individuals who like to support and give to other nonprofits or charities. The last thing under individuals is to consider, especially this time of year, if you do have investments, capital gains can be offset by capital losses. So you may you know, have a discussion with your investment person to say, well, because this is the time of the year when investments pay out capital gains, you might want to say, well, is there something I've invested in that has a loss right now? And can I offset the tax of my gain by claiming a loss and, you know, using those funds to reinvest again, but it's kind of a loss on paper. You can offset gains by losses plus $3,000. So if you have a $10,000 gain and a $13,000 loss, the extra $3,000 you can deduct as well. So you offset the 10 and get a deduction for 3. An alternative method, if you do not want to go through that discussion with your investment person, is to just recognize that capital gains are taxed at 0% up to a certain amount of taxable income. For single people, that's $44,625, and for married filing joint, that's $89,250. So you may see some of your investments, pay out capital gains, but if you are able to plan well enough and know that you can get your income down to these taxable amounts, you may still be in the 0% tax bracket. So that would be fine. A couple of credits that are available for individuals. There is a new one. It is the Energy Efficient Home Improvement Credit, and that this is 30% of the improvements. It is up to $600 credit for general improvements that are energy efficient. Windows have a separate $600 maximum. Exterior doors are $250 per door, up to $500, so enough for 2 doors. And if you have a heat pump or boiler, you can have up to a $2,000 credit. So in the past, most of the energy efficient credits were a $500 credit for your lifetime. So for most people, those were done and gone years and years ago. And so this is that has been replaced by this new credit. So if you are looking to upgrade and you see energy efficient, this might be something that you can utilize. There are still solar credits. They are starting to reduce. In the past, if you got solar, it was a 30% credit. 30% of your qualified expenses was a credit. It is now down to 26. It will continue to decline over the next few years. But there is solar. If you're interested in solar, there are credits for that, as well as EV credits. If you have an interest in getting an electric car, there are EV credits depending on the type of car and how many have already been sold. And those credits are deducted either on your tax return, or if you want, you can negotiate with the dealership to give them the credit and they can apply it as your down payment. So that is an option as well. So three new credits there. We do have the tax rates that we are currently at. They go from 10% to 37%. These have been pretty stable since 2018. And in 2018, they really widened each rate. So you can see the 12% rate is from, I'm looking at married filing joint, from $22,000 to $89,000. So that is a pretty wide range of taxable income. The same, the 22% is a $100,000 range. The 24%, again, it's only 2% higher. So that again is what? That's $170,000 range. So they have very wide brackets, which has helped a lot of people. When the tax rates came down and the brackets got wide, many people were able to look at that and keep their income, their taxable income, within a lower range. So why don't we take a look at the next? And here's the last one. This happened to be a cartoon that was kept at one of the offices I worked at. Dear IRS, Snoopy says, I'm writing to you to cancel my subscription. And don't we wish we could? Just remove my name from the mailing list. I think we all feel like that, but unfortunately it is a requirement. I'm hoping that with a little planning and just some information on what's new, you have a chance to take advantage of what's available to you to try and make your tax season a little easier. Granted, Like I said, accurate records and financial statements will help you to monitor your personal and business situations, and they give you the opportunity to plan for tax saving opportunities. So thank you for listening. I appreciate it. And if you have questions, I can certainly answer any of those.
Any questions for Sheila? It's a lot of information, Sheila. You did a great job.
It is a lot of information. And hopefully, you know, like I said, if they talk with their preparer, hopefully, you know, it's just something they can take a note and say, you know, I heard something about this. Is it something that affects me or something I can take advantage of? So thank you very much.
Yep. Last call for questions for Sheila. All right, hearing none, thank you so much, Sheila, and thank you to everybody who joined us today. Appreciate it on behalf of Renville County HRA EDA. Thank you so much for doing business in Renville County, and have a great day.
All right, thank you very much.
Thank you, everybody.